Double entry system of bookkeeping. Debit is equal to credit. A ledger format of a ledger. Two sides of a ledger. Double entry records of assets and liabilities. Double entry records for expenses and revenue. Double entry records for drawings. Balancing ledger accounts. Double entry records for sales, purchases, and returns. Inventory accounts. Goods purchased for cash or check. Goods purchased on credit. Trade credit or accounts payable. Goods sold on credit. Cash for cash, check. Goods sold on credit. Trade debtor, accounts receivable, purchase return, accounts upward, or sales return, return onward, good return. Inward, carriage inward, carriage outward, 3 column running balance account, format of 3 column running balance account. Double entry system of bookkeeping. A business would find it impossible to prepare a statement of financial position after every single transaction. The day-to-day transactions are recorded in the books of a business using double entry system of bookkeeping. The term double entry is used because the two effects of a transaction, a giving and a receiving, are both recorded in the ledger. Debit is always equal to credit. Debit is equal to credit. In order to record the two aspects of every transaction is entered twice on the debit side of one account and on the credit side of another account. The account which is receiving or gaining the value is debited. The account which is giving the value is credited. A ledger. The business maintains a separate ledger account for each type of asset, expense, liability, and income, and also for each individual debtor and creditor. Every transaction is recorded in the ledger account relating to a particular item or person. A ledger is traditionally a bound book where each account appears on a separate page. Over the years, the ledger has developed into a loosely pledged folder with separate sheets, each containing a ledger account. Recent developments have seen the introduction of computer file divided into separate ledger accounts. Format of ledger. So this is the format of ledger. Two sides of a ledger, debit side and credit side. Ledger account is divided into two sections. This can be shown by a central vertical line. The left-hand side is known as debit side and the right-hand side is known as credit side. The term debit is usually abbreviated to DR and the credit is abbreviated to CR. On either side of the account, there are columns to record the date, details, and amount of each transaction. A folio number column is used for reference purposes. The use of folio number is not required when answering questions. Double entry records for assets and liabilities. A ledger account is open for each type of asset and liability. Applying the double entry principles, every transaction is entered twice. The account which is receiving the money is debited. The account which is giving the money is credited. Double entry records for expenses and income. A ledger account is open for each type of expense and income. The same double entry principles applied to assets and liabilities are applied to expenses and income. The account which is receiving the money is debited and the account which is giving the money is credited. Double entry records for drawings. Whenever the owner of the business takes value from the business for his or own use, this is known as drawing. This value may be in the form of money, non-current assets, or goods from the inventory held by the business. It is usual to open a drawings account to record these values so that the capital account does not have a large number of entries. Any drawings are debited in the drawings account to show the value going into that account. Then credit entry will be in the account giving the value. When money is withdrawn, either the per bank or cash will be credited. When a non-current asset is withdrawn, the appropriate non-current asset account will be created. When goods are withdrawn, the purchase account will be created. This is because these goods were originally purchased for resale and the amount of goods available for resale is reduced when goods are taken by the owner. At the end of the financial year, the total of the goods account is transferred to the capital account. This reduces the amount owed by the business to the owner. Balancing ledger accounts. At the end of each month, it is usual to balance any account of assets and liabilities which contain more than one entry. The balance is the difference between the two sides of account and represent the amount which is left in that account. Double entry records for sales, purchases, and returns. It is necessary to open an account to record goods which are purchased for resale and also an account to record goods which are sold by the business. Double entry records for sales, purchases, and returns. While these are actually the same goods coming into the business and going out of the business, it is necessary to record a separate account where the purchases will be at cost price and the sales at selling price. At purchase account and a sales account are either used rather than goods account. The same double entry principle applies to assets and liabilities are applied to purchases, sales, and returns. Inventory. An inventory account is only used to record the goods left at the end of the financial year and not for day-to-day transactions. Goods purchased for cash or check. Whenever goods are purchased, the purchase account will be debited if the goods are coming into the business and the business purchase account is receiving the return. The double entry will be credited in either the cash account or the bank account depending on whether the amount was paid in cash or by check. Goods purchased on credit. It is common for business to buy on a credit and pay for the goods at a later date rather than at the time of purchase. The purchase account will be debited in the usual way. Trade creditors account payable. The credit entry will be made in the account of the supplier of the goods to show the value coming from that person. The supplier of the goods is known as trade creditor or account payable. When a payment is made to the supplier, the bank account will be credited to show value going out of that account. And the account of the supplier will be debited to show value going into that account. Goods sold for cash or check. Whenever goods are sold, the sales account will be credited as the goods are going out of the business, and the sales account is giving out the value. The debit entry will be of debit in either the cash account or the bank account, depending on whether the amount was received in cash or by check. Goods sold on credit. Just as the business may purchase goods and pay for them at a later date, it may also sell goods on credit. The sales account will be entered in the usual way. Debit entry will be made in the account of the customer, accounts receivable to whom the goods are sold to show the value going out to that person. Trade debtor or accounts receivable. The customer who bought the goods on credit is known as trade debtor. When a payment is received from the debtor, the bank or cash account will be debited to show value coming into that account, and the account of the debtor will be credited to show value going out of that account. Purchase return or return outward of goods outwards. Now, sometimes goods which have been purchased have to be returned to the supplier. This may be faulty, damaged, or not what was ordered. These goods are known as purchase returns or return outward. A special account known as purchase returns account or return outward account is opened, and any returns are collected to this account to show the value going out. The debit entry will be made in the account of the supplier to whom the goods are being returned to show the value going out to that person. Sales return or returning note or goods in note. Similarly, a customer may return goods to the business. These goods are known as sales return or returning notes. An account known as sales return account or return is opened, and any returns are debited to this account to show the value coming in. The credit entry will be made in the account of the customer who returned the good to show the value coming into that person. Double entry records for carriage inwards and carriage outwards. The term carriage refers to the cost of carrying of transportation goods. Carriage inward is part of the cost of purchasing goods, which occurs when a business has to pay for goods it has purchased to be delivered to its premises. Double entry records for carriage inwards and carriage outwards. Carriage outward is a selling expense as it occurs when a business pays for goods to be delivered to the customer's premises. It is important that these two expenses are treated separately in the accounts. Carriage inward, carriage outward. Goods cost. Carriage is the cost of transporting goods. Carriage inward the cost of bringing the goods to the business, and carriage with the cost of delivering the goods to the customer. Three-column running balance accounts. The ledger account presented so far have been in traditional form. This is also known as the T account format. There is another method of presenting ledger account which is commonly used in computer generated accounts, which is known as three-column running balance format. The form of presentation uses only one column each for the date, detail, and folio, and has three money columns side by side, one for debit, one for credit, and one for balance each transaction. The advantage of this method is that it shows the balance of that account after every transaction, and the account are prepared manually. It involves extra calculation into errors.